Well, today I'm pleased to welcome Brett Hanson back to the studio at Bay Radio. How are you doing, Brett?
I'm doing great, Howard. Really good. What about yourself? How's things?
Well, let's say I'm coping, because these are unsettling times in the world again. From a geopolitical point of view, unsettling times can make investors nervous. But how should investors react at times like this? Brett will put things into perspective for us and share his investment experience and insights. So, Brett, I guess even all of us know investment markets don't like uncertainty. But are they always impacted by geopolitical tensions? What reassurance can you give investors who are concerned about the Middle East situation? And what can we learn from previous political tensions and the market uncertainty?
Yes, Howard. It's a really important question, and it's something investors naturally worry about. Markets don't like uncertainty, that's absolutely true. And geopolitical tensions can create short-term volatility because investors don't yet know what the economic impact might be. But I think the key thing to keep in mind is that this isn't new. Markets have lived through decades of geopolitical events, including conflicts, political instability, and global tensions. And while they often react in the short term, over the longer term, they've shown a remarkable ability to recover and keep moving forward. So the reassurance I'd give is this. Short-term market movements are often driven by sentiment and headlines, but long-term returns are driven by things like companies' earnings, innovation, and economic growth. Those fundamentals don't usually change overnight because of a single event. What we can learn from the past is that reacting emotionally to uncertainty, i.e. selling out or trying to sidestep volatility, can often do more harm than good. Investors who stay disciplined and focused on their long-term goals tend to be better rewarded than those who try to react to every headline.
Can you remind us about the time, not timing, investment principle?
Yes, and this really sits at the heart of successful investing. Time in the market simply means staying invested and allowing your money to grow over time rather than trying to predict the perfect moments to buy and sell. The problem with time in the market is that it's incredibly difficult, even for experienced investors. You not only have to decide when to get out, but also when to get back in. And those decisions often need to be made during periods of uncertainty when emotions are running high. What often happens, Howard, is that investors step out during a period of volatility but then hesitate to reinvest, and in doing so they miss some of the market's strongest recovery days. And those recovery periods can come very quickly and unexpectedly. For example, back at the beginning of this century, we saw the leading US index, the SP 500, go from over 1,500 in July 2000 down to around 800 by October 2021. That's nearly a 50% drop in the stock market, and markets fell for a number of reasons, which included the bursting of the dot-com bubble, 9/11, and the build-up of US and its allies' military off the coast of Iraq. At the time, the news was very negative and the general outlook was grim, with the expectation that military action in Iraq could be another Vietnam. And yet, when in March 2003, President George Bush gave the order to start military action, rather than stock markets go down further because of the uncertainty and the negative outlook, they started to rise and continued going up until mid-2007. Likewise, we saw stock markets fall around 30% from mid-February to mid-March at the beginning of the pandemic in 2020. But again, stock markets recovered and even made gains before the year ended, despite the fact there was no vaccine at the time, we were still experiencing lockdowns, and there was still a huge amount of uncertainty surrounding the pandemic. History shows that over time, Howard, markets tend to reward patience, and compounding, which is the ability for returns to build on themselves, is one of the most powerful forces in investing. But it only really works if you stay invested. So rather than trying to outguess the market, a more reliable approach is to remain consistent, stay invested, and focus on the long-term picture.
Many people invest by buying equity and bond funds, where buying and selling assets within the fund is done by experienced professional fund managers. What would these fund managers be doing during periods of uncertainty to keep their funds on an even keel?
That's a really good question, Howard, because a lot of people invest through funds and might wonder what's happening behind the scenes during these periods. Fund managers are constantly monitoring markets and reviewing their portfolios, but importantly, they're doing so with a long-term strategy in mind. They're not reacting to every headline. Instead, they're assessing whether any developments genuinely change the outlook for the companies or assets they're invested in. During uncertain periods, they might rebalance portfolios, so for example, trimming positions that have become too large or add into areas that look undervalued. They'll also look closely at risk, making sure the portfolio remains diversified across different sectors, regions, and asset types. In some cases, they might slightly adjust their positioning, perhaps becoming a little bit more defensive or increasing exposure to more resilient sectors. But it's usually measured and deliberate rather than reactive. The key thing is that professional managers are there to provide discipline. They follow an investment process, they rely on research and data, and their job is to navigate through uncertainty without losing sight of the long-term objectives of the fund.
Finally, what other advice do you have for investors at times like this?
I think the most important advice, Howard, is to stay calm. Try and stay objective and keep focus on your plan. It's completely natural to feel uneasy when markets are volatile or when there's unsettling news. But making decisions based on emotion is often where investors run into trouble. It's really important to have a clear understanding of why you're investing, whether that's for retirement, a major life goal, or building long-term wealth for future inheritors, and to make sure your investments are aligned with that time frame. Diversification is also key. Spreading your investments across different asset types, sectors and regions can help manage risk and smooth out the ups and downs. Another helpful approach is to review your portfolio periodically, but not constantly. You don't need to react to daily market movements. Instead, check that your investments still match your goals and risk tolerance. This is why it's important to ensure that you're using an experienced, qualified and regulated advisor who has the resources to be able to provide appropriate investment managers and ongoing reviews. And if you're not getting this, why not speak to us at Blevins Franks, where we can provide guidance tailored to your situation. But overall, the message is this, Howard. Investing is a long-term plan. There will always be periods of uncertainty, but staying disciplined and patient is usually the best course of action, provided your investments are in line with both your objectives and risk tolerance.
And the website is the first port of call.
Yes, absolutely, Howard. If anyone would like to find out more about us, what we do, or would like to speak to their local advisor, then they can contact us via our website, blevinsfranks.com.
Many thanks.